After watching this entire video, you'll know exactly how to start investing in 5 steps, as simply as possible, and you can start today to double your money in at least 7 years. Well, of course, everyone wants to hear nice stories, hearing about doubling your money in a year, but here we are being realistic. Happy investors. My name is Jorik Vermeulen. I have been an investor and entrepreneur for over 10 years. In the meantime, my wealth has grown to about 425,000 in investment capital, so liquid cash, what has been invested in stocks, ETFs, and also a software, startup, company. In addition, I have my own business, and through our YouTube channel, I help you with tips to grow your wealth, honest tips, because that's what we stand for, and especially simple investing. You don't need expensive financial advisors. You don't need expensive wealth managers. Maybe it's a good idea to invest in yourself, for example, to gain knowledge alone. In this video, I can guarantee you that in 5 steps, are you learning how to double your money in 7 years in a way that is super simple and actually doesn't take much time at all? Now, before I explain the 5 steps to you, I would really appreciate it if you could like the video and subscribe, because these videos are valuable enough. Maybe it's not super nice in terms of video quality, editing, and such. That's something that will also come this year, and I'll explain what my journey is. But it's simply about sharing videos to help you achieve financial freedom. So when you do that, I would really appreciate it. If you could take a moment to subscribe and give a like. Now let's take a look at the 5 steps. We're going to start with the first step, but before we do that, go ahead, make me a promise about what you want. Promise yourself that today you will at least take the first step. And the first step is very simple. Determine how much you can invest monthly. The basic principle here is that whatever you invest, you should always be able to afford to lose, not just tomorrow, next week, but at all times. That means you have to assume that you permanently have a loss with that money. Why? Mentally, it can only be a relief. But much more importantly, you always need to have your basic finances in order. You need to have your basic finances in order, which you can definitely do by setting up a savings emergency fund. And you can do that a few times in your monthly income. But also keep in mind larger potential expenses, like if your car breaks down or the washing machine goes broken. So you do need a little bit of thinking power to have a clear view of your finances. But it's relatively simple. To determine a monthly contribution amount, you do that by focusing on 2 things to increase your chances of success. The easiest way is to save costs in the short term. Now, I'm 33, but when I was 30, I was already earning around 200,000 per year. And now I'm actually earning a bit less. Conscious choice, because I'm going to work a bit less. Money isn't important. Financial freedom is much more important. Wealth is about how much more time you have. And despite all that, look at, for example, my video location. This is just in one of my rooms. I have a perfectly nice, beautiful house, quite renovated, also this year, but no expensive studios. That camera you see here costs 150 euros. I have a different microphone setup, and I have a camera that only costs 80 euros. I don't rent expensive offices. I'm in an office at my dad's place, upstairs in the business. And I'm sure you can also find a little office in a very smart way. Keep your costs as low as possible. I built a whole online business with just a laptop, and I even bought it refurbished. So for 100 or 200 euros, and that lasted for 2 years, you can keep your costs low in all sorts of ways. And there's really only one barrier to keeping your costs low, and that is you. What's in the way is your own ego. Materialism. What a sigh. Show it off to your friends like, oh, look at me driving a BMW, who cares? You can keep your costs as low as you want. There is a small nuance here. This is especially for when you're, let's say, a student or a young professional, and in the meantime, you keep getting older and older. That's the same for me. And of course, for some, I'm still a kid. However, you get older, and something that is even more valuable than that. There are a lot of things more valuable than money, but something that is definitely more valuable than money is it's your time. So at some point, you shouldn't cut back on basic things anymore. And should you start investing to create more time for yourself? For example, for my own story, and that was actually decided just this weekend, we're going to hire my little sister, also at Happy Investors. That's actually going to be the 5th or maybe the 6th, because we're growing fast, and she's going to do all sorts of tasks that I can keep for her. Sources. This way I create more time, but much more importantly, besides getting more time, I'm also giving her a much better job. because there's a huge potential for growth in that, also for the future. That's an example of investing safely, also for a better return, namely a lot more time, but we're still here to double your assets. So you're going to do a bit of budgeting at first if necessary, apply, and you really only need to cut back on one thing so that you can set aside at least 100 euros or preferably 200 euros per month. Is that not possible? It works, but for example, to free up 100 euros or 50 euros, so save up for 2 months. And instead of investing monthly, you're going to invest every 2 months. Why? That has to do with reducing some costs on the transaction fees you'll incur when you make an investment. I'll say a bit more about that in a moment. But the last remark about step one, which is to determine your monthly budget, is when you've made some cost cuts and built up your emergency fund, after that, you just need to start investing. And much more importantly, in the present time, is to focus on earning more money. Earning more money is not only a lot more fun, it also makes life easier. And then you don't have to focus your limited capacity on saving anymore, but on how can I earn more money? A lot more fun, and I speak from experience, that's where you get more energy from. And making money doesn't have to come at the expense of others. You actually earn a lot of money by providing a lot of added value. Could also be to your manager, for your own business. It doesn't matter. Finally, take a look at our website. There you'll find a calculator, a little calculator that I built myself in Excel when I was about 25. I've been using it for a very long time. In principle, you can calculate your wealth on a single A4 sheet. So you just fill in how much you're going to invest monthly. Your wealth, calculate it. So you just fill in how much you're going to invest monthly. And it actually produces a little graph, and you can determine your end time in terms of wealth growth. I still have some other texts on my mind to remind myself what my highest priorities are, like my family, working with joy, working with people I love, ikigai, those kinds of things. And basically, I've summarized my investment strategy on a single A4 sheet, but you can't do that just by simple investing or advanced investing alone. Now, the first step is to invest monthly or bi-monthly. And then step two is to select an investment account. And step two, we can actually be very simple and brief about that. There are a number of investment platforms that are relatively inexpensive and user-friendly. I want to assure you, you won't find that at your bank. Of course, ABN, Rabobank, they all want you to expand your savings with investment assets. An investment account might sound very simple and quick to set up. But be careful. These are definitely not the right investment platforms. What then? Well, there are a few more well-known ones in the Netherlands, and I'm not here to promote them. We do have affiliate links for investment accounts that we invest through, and we have positive experiences with them. And an affiliate link means that if you click on it, it won't cost you anything at all. But then we receive a small commission when you create an account. So that's a way of giving back for the free knowledge we provide to you. But you can also easily compare investment platforms on the internet yourself. It's that simple. Once you've set up and configured your account, then you can, of course, start transferring your first monthly amount. And then it's time to make the investment. That's what you're here for in this video. I told you my promise is in this video, you'll learn how to double your wealth in 7 years. And I also promised you that it can be done in a very simple, accessible, and passive way. Before I share that with you, I'm going to grab some coffee first, and then I'll explain it to you. So, we're back. Had some nice coffee, got some energy, and we're going to talk about step 3, which is starting with simple investing. And you do that using an investment portfolio. What is that then? An investment portfolio? Basically, it's the composition of different investments, but I promised you that it can be done in the simplest way possible, and that we also want to double our money in 7 years. How do we do that? There's a simple investing experiment, and that is the rule of 72. For example, if you want to double your wealth in 7 years, you divide 72 so that you end up with 7. And if you divide 72 by 10, you get 7.2. So basically, we need 7.2 years to double our money. How? 10 stands for the return you need to achieve annually. That means you need to achieve a 10% return per year. There are a few ways about how you can still relatively easily achieve an average return of 10% per year. There's just one unfortunate exception, and that 10% does include inflation. And inflation, that's a silent killer. So that's always something you need to keep in mind. I had already mentioned the account tool that I had set up. There you can also indicate a bit of inflation. But aside from inflation, you could simply double your wealth with a 10% return. By far the best way to do that is long-term investing in stocks. Stocks historically achieve the highest possible return for the beginner investor. Why? Well, there are of course other ways to achieve high returns. Achievable return for the beginner investor. Why? Well, there are of course other ways to achieve high returns. You can also do it with stocks. For example, you can invest in higher risk. Okay, companies like I do myself. Also, that's why I had shared that I frequently share my investment portfolio on our channel, where I give complete insight into which stocks and stock funds I invest in, and that on a monthly basis. For that, you subscribe to our channel. Then you can automatically receive and follow that. But putting that aside, that's all more demanding. You can also do day trading, even riskier, crypto, maybe completely risky, and also speculative, where you're not really sure what you're doing. And then you have investment methods that aren't really accessible for beginners, like private equity or venture capitalists. Now, the most accessible way to start quickly and simply today is to determine your monthly contribution. Set up an investment account today, and step 3 is to invest in a global ETF. Maybe even better would just be the S&P 500. What is the S&P 500? We've also made several videos about it. Moreover, we also make a lot of videos about investing in ETFs to help inspire you. But actually, you should only need to invest in a global ETF or the S&P 500. With the S&P 500, there's a chance of an average return of 10% per year, a little higher. Why? It's a kind of index fund. You should see it as a playlist where 500 American companies are included. You're basically just investing in a kind of American economy. There are 500 that all need to be profitable. That's one of the criteria of the S&P 500. And of course, the biggest players are in here like Apple, Nvidia, Tesla. And those stocks or those companies generate revenue and profit worldwide. So not just in America, but also South America, Europe, Asia. So even though it may seem concentrated that you're only investing in the S&P 500, it's still definitely a bit of diversification across the world. And in the S&P 500 is by far one of the best. Stock funds that you can invest in are very passive and also come with lower risk. And the reason for the lower risk is very simple. They're trying to make it all very complicated, those investment advisors. However, statistically speaking, the failure is filled with 25 stocks. You achieve almost maximum risk diversification. With a solid 30, you can achieve 99.2%, 99.2%, achieving risk diversification. And with 50 stocks, you might reach 99.9%. But more than that is completely pointless. So with just 25 stocks, you already have about 97% risk diversification. It might sound strange, but it actually just means or you invest in a portfolio with about 10 to 15 stocks because you are a great stock investor, or you might as well just invest in a simple, cheap one. Investing, and that's what they call an ETF, because you still achieve the same risk diversification. And then the only thing you have to do is just be very passive investing. And we do that with step 4. But before I explain step 4 to you, the S&P 500 ETF, it's actually very easy to find through your investment account. You said after this video, you can definitely start today. So you've created an investment account. You log in and you can basically buy that stock fund right away. An alternative is, for example, a global ETF. What's the difference between the two? Well, the S&P 500 consists of 500 companies that are all located in America. As I said, they do generate revenue from all over the world. But basically, they are concentrated in America. If you're not feeling completely comfortable, then you can still buy an ETF that actually provides global diversification. Often, about 70% is still located in America and 30% is elsewhere. That actually provides global diversification. Often, about 70% is still located in America and 30% is elsewhere, in Europe and Asia. The writing in the world of investing mainly revolves around America. I want to be the superpower. And, for example, China still doesn't represent much in the world of investing. America, that's where the action is. And there are always situational ups and downs. A Trump being appointed, ups and downs. A Trump being appointed. An economy that has taken a significant dip, but America will likely still be a major power for the next 10 years. That's definitely very plausible. Moreover, the economy is such that it's just super interesting for capitalism to thrive in America. So that's really by far the best choice. Also, in comparison to, for example, the Netherlands, S&P 500 or a global ETF, well, if you don't know what that means, check out our channel. We'll explain. For example, we made a video that's called 5 of the best ETFs for simple investing. And the S&P 500 is one of them. And the other 4 include, for example, a global ETF and a dividend ETF. Then you'll find all the information you need to start investing today. Then, step 4 is about DCA. I'll explain what that means. Now, you all know those stories, especially when you talk about investing with your parents. Oh, watch out, losing money, be careful with your money. I lost money so many years ago. Yes, if you don't know what you're doing, you'll lose money. But a very simple solution is simply in your mindset and a certain action. Step 4 is to apply DCA, and DCA stands for dollar cost averaging. This is actually the usual term for just investing periodically every month or every 2 months. Why is this super important? And that you also stay consistent with this, hang in there for the next 7 years. Well, the stock market goes up and down, and those emotions are crucial. You don't have to be a super or intelligent person to be successful in the world of investing. A certain level of intelligence might be nice, but what's much more important is that you have discipline in your emotions. So it's really simple to do that. Just accept it for yourself. I'm going to invest a certain amount every month or every 2 months, which I can 100% afford to lose. Absolutely fine. And I actually don't look at it any further. All I do is log in once a month. I buy those stock funds, the global ETFs or the S&P 500, and that's what I do. And important tip, also don't download the investment app on your phone. They try to trigger you to trade, to buy and sell. This specific video is all about how you can invest money as simply as possible. And you can double your money again in 7 years. And then I can strongly recommend you don't download any investment app. All you have to do is set aside that amount. Buy every month and just set a reminder in your calendar to do that, or do it every 2 months. But why is this so important? And this is called dollar cost averaging, or because the stock market goes up and down. And the reason people invest money is because when the stock market drops, look, they buy panic in the market. However, that is precisely the ultimate moment to buy. So in those ups and downs, you especially want to buy more during the downs. But it's quite difficult to have the exact market timing. Of course, ideally, you only want to invest when the markets are super low, and then it will start to rise. If you wait too long, the only thing that can happen is that the stock market keeps rising, and then it drops once, and then it's actually still up when it climbs again, above the amount you could have initially invested. So to avoid all that, to prevent all that complexity, you just apply DCA. In other words, invest monthly or bi-monthly. Then you don't have to think about it. The stock market is currently high. Yes. Specifically, at the time of making this video, the stock market is very high, especially the S&P 500, but also a bit of the global ETF, if you choose to do so. So this is by far not the perfect time to start. But yeah, there's always a reason to hesitate. That's the whole point. And that's why with DCA, by averaging your investment, you invest every month or every 2 months. Can you prevent that? Can you prevent yourself from thinking, I'll wait a little longer, a few months, because there might be a market correction coming? But no one knows for sure when that market correction will come. And a really big classic mistake is that you start thinking, oh, the market is going to drop. Well, then it doesn't happen. It just keeps rising. And then you still jump in with a lot of money at the highest point, and then you'll see that the stock market starts to drop. So it prevents all that misery. But I speak from experience. I thought I was smarter than the market. What happened? Corona crisis. Such a beautiful portfolio, good stocks, ETFs. The portfolio dropped very hard, something like 30%, 35%. And then a few months' time, and I was really happy at that moment. I went all in. So that was actually a really good initiative on my part, a very good choice. But what happened? I thought I was being smart about the market, and my investment portfolio was rising really quickly, and it actually surpassed the previous stock price at a rapid pace. But this was the whole context in which Corona was still in effect, and it was still not entirely certain whether everything was really going in the right direction. So what did I think? Yeah, this is all happening way too fast. I sell a lot of my positions and I wait for the stock market further down. Well, it didn't happen. It just kept rising. And then it still gets to you, and you end up buying some stocks here and there, buy more. And yes, in 2022, there was a huge decline that continued into 2023. Well, luckily, I bought a lot more in the following years. But if you try to outsmart the market, it often backfires on you. It backfires on you. So you can, speaking from personal experience, don't try to time the market. Often it just disappoints you. And that's also how the more you get involved with it, the more these pitfalls arise. So the less you get involved with it, and the simpler and more passive you keep it, the higher your chances of success. Sounds paradoxical, but this is really how it is now. And that's, of course, on the condition that you only invest in a global ETF, or for example, the S&P 500, where you invest in more risky products, like a risky thematic ETF, for example. That's technology. That will have stronger ups and downs. That might require a bit more attention and time, especially if you choose to go for individual stocks. But at Happy Investors, we now have about 815 members. It's actually growing a lot quickly. Every month we really gain a lot there. So we're in a really good phase. Well, that's nice for us. The only tip I want to give is we guide all those people. And the most common pitfall is that they initially take on too much risk. We actually bring everyone back to reality for a moment with a safe foundation. Keep it simple. Keep the costs low and just start with a small amount. And a lot of people want to start right away with individual stocks. But the reality is, I think 39% are not ready for it. Only 1% are ready to do that. Not just mentally, but also in terms of skills. So you can reduce all that complexity simply by safer, lower risk ETF. I think I've said enough about this, but you might still have questions about it. This is not a concrete how-to video showing how I do everything in my investment portfolio. We have other videos for that. Here's a step-by-step plan in 5 steps to double your money in a very simple way in 7 years. So do you have any questions? Let me know in the comments, and then I'll help you with that. Now, the very last step of the plan is keep learning, and above all, never disrupt the compounding interest effect. Compounding means stacking up. When you want to become richer, you really need to look at what you are very good at. Building a skill within your strengths and continuously improving that skill so you can get more results for the same effort. Simply put, you become an expert in what you do. The compounding of knowledge is the greatest and most shocking compounding effect you can create, because knowledge always stays right here. No one can take that away from you. And in the long run, you can become incredibly prosperous from that. Simply by becoming smarter, life is that easy. Look, for example, in your career, there are probably people who are 55 or 60 years old sitting in a certain position. And then you think, how is that possible? How did you get that position? Those people are often not above average in intelligence. No, they've just been in the same field for years. And then you naturally end up in that position and earn a lot of money, while they might not actually be suited for it. But that's the effect of compounding interest. And you create that same compounding effect by investing your money for the long term. And the absolute necessary condition is to never disrupt that process. I mentioned it earlier. The stories about losing money in investing are because these people don't have their emotions under control. When the stock market drops, it drops hard. It's much harder to create a positive return. And even after 3 years, you see returns, bam. In just a few weeks, it's possible for the returns to be new or even negative. That is yes. How do you say it? The stock market is not suitable for everyone. To prevent that, you need to keep investing, especially when that market drops. And if that market drops by, say, 20% or 30% or even 50%, that's the moment you want to invest extra money. Investing, because then you can slightly increase your return, your million taken out. Only a lot of people do it the other way around. They disrupt the effect of compounding. So when the stock market drops hard, just like I made that mistake. I bought in really well then, but I made the mistake of selling when it was rising sharply. Well, you definitely don't want to do that. You just need to buy more, especially when it drops. And a bonus could be that you sell when the market is overvalued. Only then do you run into the potential pitfall of trying to time the market. Timing. So, the easiest, simplest way for beginner investors is actually the summary of this video, namely, step 1. We have determined the monthly contribution. You've either applied some savings or earned more money, and you have an amount, for example, 200 euros per month, what you can invest every month or every 2 months, and assuming that you're going to lose 100%. Next, you create an investment account, choose your broker according to your preference, and Zeta. It's a matter of comparing, but not difficult. Step 3, assemble an investment portfolio. You can simply start with one investment product, namely an S&P 500 or a global ETF. Are there more ways to spread risk? Sure, you can, for example, supplement with real estate funds, a bit of crowdfunding, perhaps, and there are a few other relatively simple passive investments, but we'll explain that in other videos. Step 4, we're going to apply DCA, dollar cost averaging. So every month you buy more, especially when the stock markets are falling, you buy more and you keep buying even when it's rising. All you do is just log in once every month or 2 months, buy more, and that's it. Definitely don't download the investment app on your mobile. Stick to this structure. Finally, keep learning, keep deepening your knowledge, because maybe in the long run you can take on higher risk as you become more skilled in, for example, stocks, or maybe thematic ETFs to achieve a somewhat higher return. Meanwhile, that 10% return we need to double our money in 7 years? Yes, that might be disappointing over 7 years. It really depends on how the stock market is doing. But in the very long term, it almost always pays off to take high risks in a controlled way. To understand that, we need a lot more text and explanation. So we just keep it at this. But the very last step, and this is the most important one, is you keep going. You shouldn't stop this process. If you stop and start selling when you're significantly in the red, then you have a loss. Then you're doing it wrong. That sounds really bad, easy. But believe me, my portfolio was in the red several times at the beginning. I once lost 40,000. I lost a lot of money in a very short time. I once had 25,000 euros now lost because I was too eager. And I had invested in a very risky small stock. Super dumb. Fortunately, I have too. Made big profits, but super dumb. And you just have to keep going on this journey. I've been doing this for over 10 years now. I have mainly experienced an upward stock market. Well, a big correction in 2021, 2022. And of course, the corona crisis. It could very well be that a big correction is coming in the short term. But yeah, time will tell. The most important thing is actually to create a sort of callus on your brain that when you see your red numbers, that you just disconnect yourself from reality for a moment and think, nice and interesting. They're just numbers. I'm going to take my dog for a walk. Just exercise. Don't think about it anymore. Let it go. It's just money. Not important. Much more important is that you do what you enjoy, that you engage in loving relationships. What you enjoy, that you engage in loving relationships with people who really want to be with you. And above all, just find joy and satisfaction in the here and now. And in the meantime, you let this crazy world of the stock market work for you. And if you just do this for 7 years, the chance that you double your money is quite high. If after 7 years it still doesn't work out, it could be that during that period things just aren't going your way. Then you probably need another 1 or 2 years to make it right. But let's say it's then 10 years. So be it. In a very simple way without making many mistakes. Can you invest your money in a very simple way and therefore achieve returns to double your money? And that's it. It's really nothing more than that. Well, thank you for watching. I hope you find it valuable enough. You probably have a lot of questions. Let me know. It's the simplest, honest way. I can assure you, of course, there are many pros and cons, ifs and buts. But if you eliminate all that and remove the complexity, it's just this, the way you can become rich in a very passive manner